Good day. Thank you for joining me. My name is Warren Davison and I'll be taking you through the June 2020 PSG Wealth Offshore Fund of Fund performance. The ease of COVID-19 lockdowns and the early signs of economic recovery saw the risk appetite return rapidly in Q2, supporting both equities and credit markets. The US rebounded in the second quarter and outperformed the major equity markets. Improving jobs and retail sales data provided cause for the optimism. Eurozone shares posted strong gains in Q2 as lockdown restrictions were eased. Another source of support was news of EU plans for post-COVID-19 recovery, with the European Commission proposing a €750 billion fund. UK equities rose over the period. Having contained the first wave of COVID-19, national lockdown measures were eased. Meanwhile, economic indicators suggested the downturn had passed its worst point. Japanese shares also gained, supported by their improved global picture. Stocks sensitive to the economic cycle tended to fare best, while domestic-focused stocks underperformed. Emerging market equities advanced amid global monetary and fiscal stimulus. However, there was an acceleration in the number of new daily cases of COVID-19 in some EM countries. Having a look at the fixed income indices, most indices are now printing once again in the green, with the exception of emerging markets and high-yield indices. In government bonds, US and German 10-year yields saw little change in the quarter, while corporate bonds outperformed governments. A strong rally was seen in emerging market high-yield bonds, producing a 4.22% return for the month. Looking at another matrix and breaking it down into the fixed income indices by their different maturities, as well as government, corporate, and high yield. For the month, a strong risk-on sentiment caused high-yield bonds to outperform corporate and governments. The biggest change on a year-to-date basis was long-term high-yield bonds with a change of 4.12%. while the smallest change on a year-to-date basis was short-term government bonds, which changed by 4 basis points. Looking into the PSG philosophy, our objective is again not to back one horse, but to spread the bet across horses which we feel have a competitive advantage at what they do, whether it be their style, thinking, or other aspects. We then combine these to produce a final portfolio solution which looks to achieve our 3 pillars. Firstly, consistent above average performance, which is measured by first and second quartile. Below average risk, focusing on the Sharpe ratios, and at a competitive price relative to its peers. Looking at the global portfolios, we'll start by looking at the asset allocation and remembering that all of the PSG Wealth Global Fund of Funds are multi-asset portfolios and therefore include both equity and fixed income investments. Looking into fixed income, as I showed earlier, this asset class will include exposure to governments, corporates, and high-yield fixed income, and will therefore react accordingly within the portfolios. Looking at the quartile rankings, relative rankings remain strong across the board, however, a mixed bag over the 1-month period. Longer-term numbers still remain favourable. Over the recommended holding period, which is illustrated by the rectangles, here we have achieved average and above performance for 5 of the 6 funds. Looking at some of the highlights for the month, the PSG selected managers had a good month, with 65% of the underlying managers outperforming the peer group average over the last month. Looking at styles, value stocks lagged growth for the quarter, with the MSCI World Value and MSCI World Growth net return returning 12.9% and 25.6% respectively for the quarter. Looking at the quantitative risk radar, the managers bounced back strongly for the month, with all of the funds coming off both the quantitative and qualitative risk radar. Looking into the global preserver, the fund produced a 1.32% return in June, underperforming its sector for the month by 7 basis points. The fund has unfortunately fallen behind the sector over the recommended holding period of 3 years by a narrow margin. We can see from the relative tables that the 3-year number has felt the pressure of the global sell-off. However, longer-term numbers remain first and second quartile. It is important to remember that the fund does hold roughly 20% in equity and will experience increased volatility during times like this. The recent market impact affected the fund in 2 ways. Firstly, equity markets detracted, in particular dividend-paying stocks. And secondly, global credit spreads widened, causing a price decline on those fixed income securities. Onto the global moderate. The fund produced a 1.81% return for June, underperforming its sector for the month by 6 basis points. The fund is above its benchmark over the recommended holding period of 5 years by 35 basis points. Again, looking at the relative ranking tables, here we can see that the fund has remained above average over all observed periods. Onto the global flexible. The fund produced a 2.47% return in June, outperforming its sector for the month by 82 basis points. The fund has outperformed its sector over the recommended investment horizon of 7 years by 5.69%. As you can see from the relative tables, the fund remains top quartile over all periods. Onto the global creator. The fund has produced a 1.22% return in June, underperforming its sector for the month by 1.25%. The fund, however, has outperformed its sector average over the recommended investment horizon of 7 years by 2.83%. As you can see from the relative tables, the fund has held up well over all periods, remaining top quartile. As a conclusion, we can see that each fund is delivering on the 3 pillars of consistent above average performance, below average risk, and at a competitive fee. Thank you. Please take note of the following disclaimer and please reach out if you have any questions.